Hello everyone. In the previous video, we have seen the accounting life cycle and we also seen a practical example like how the accounting life cycle is applied in a real time by seeing an example. Now in this session, we'll see what is the life cycle of a fund and how the accounting and accounting life cycle are applied for a fund transaction. We will take a couple of transactions of the fund and then we'll apply the accounting concepts like a cash accounting and accrual accounting. Will I apply these concepts to the fund accounting? To start with, what is the basic life cycle of a fund? So the fund has a four major life cycle, four major stages. One is a launch stage. A fund when is launched, basically what happens is the fund collects the investments from the investors. So we call this as a, depending on the type of fund, we call this as a subscriptions in case of mutual funds or hedge funds, or in case of private equity funds, we call this as a capital calls. So where the investment manager basically raises the capital through from the various investors. The second is pooling of, now similar from across the investors, the fund raises the capital and it pools the money or collects the money. That is basically the second stage of a fund life cycle. The third stage is investing. So all the money which actually collected, the fund manager or investment manager invest in various securities depending on whether it's a mutual fund or a hedge fund or a private equity fund. Now the investments is done across different asset classes like equities, fixed income, cryptos, commodities, real estate, etc. And the last is fund return. Once the fund generates the return, this return is passed back to the investor in the form of distributions. Now to summarize, there are four stages. A fund is launched, the fund pools the money across from the investors, the fund invests in the securities, and the return generated by the fund is passed back to the investors in the form of distribution. So these are the four stages of a life cycle of a fund. Now, what are the concepts we have learned in the previous videos? Let's apply for the fund. So let's take some of the examples. Let's say we have learned in this session, let's talk about, we have learned the modern approach, where the modern approach basically what we do is when there is an increase in the asset, we debit it, and when there is an increase in the liability, we credit it. And whenever there is a decrease in the asset, we credit it, and whenever there is a decrease in the liabilities, we debit it. So what we will do is we will just apply this rule for a transaction. Let's say the fund purchase a security for when they buy a securities. So they buy a security for $2,000. Now in this account, there are two accounts are getting affected. One is the securities account, other one is a cash account. Both securities or financial instruments and cash are belong to real accounting. So here when the firm purchases securities, the security which is asset value increases. So we are debiting securities account, we debit for $2,000, and the cash which is used for purchasing security actually decreases. So when a asset decreases, we actually apply credit for that one. So the rule over here is securities account debit to cash account credit. So this is the entry passed when a firm purchases a security. Now let's look at another example. Let's say there is a payment of annual audit fees. Now audit fees is an expenditure. Okay. And whenever there is an increase in expenditures they come under the nominal account rule. So here what you do is whenever there is a increase in the expenses or losses, you debit it. So here the audit fee which is expenditure is actually increasing. So what we do is we debit audit fees for $1,000 and the audit fees is paid through cash. So the cash is a real account. When audit fees is paid, the balance is decreases. So we credit it. So the rule for the expenses is audit fee debit and cash account credit. The third entry is, let's say they sell a bond. They sell a bond for €7,000. Now if you see, there are two entries getting affected. One is a cash is an asset, and other one is securities, which is typically in this example is a bond here. Now here the cash is increasing because when the company sells the bond, they are getting the cash. The cash is increasing. So cash we debit it, and the bond, which is another asset, when the bond gets sold, the balance of the bond in the books decreases. So here we are crediting it because whenever the asset gets decreased, you have to credit. The rule, so the accounting entry here is cash account for $7,000 debit and security account, which is like bond, which is credit. So this is the entry we need to pass when there is a when there is a sale of securities. Now what happens, what is the entries typically when the mutual funds pass, when they receive when mutual funds or hedge funds pass, when they receive the subscriptions. Now basically subscriptions are received on a T+1 basis or a T+2 basis depending on the market which they are operating. Some markets the subscriptions are settled on T+1 basis and some markets they are settled on T+2 basis. Now the day of T+0 where the subscription entry is registered with the transfer agent, the amount will be amount receivable debit versus capital. Now why we say amount receivable is amount is not received, they are just booked the subscription. So we pass the entry of amount receivable, we will say debit, and capital account we create it because that's a capital. And on the day of receipt of subscription proceeds from the investor, the transfer agents books the entry as bank account. Why bank or they book the entry as bank account or a cash account, and they they credit amount receivable for shares issued. So this is the entry. The entry is passed. Basically, whenever there is a subscription, the entry is done in two stages. One on the T+0 basis, whenever there is a recording of subscription is done, and when the subscription gets settled on the T+1 or T+2 basis, the second entry is passed. Now let's look at how the entries are done for the accounting. Very similar to subscriptions, the accounting for investments also done in the two stages. Now you might have learned about like trade date and settlement date. So basically trade date is where the firm or a fund books the trade, and settlement date is where the trade is settled. So on the day of trade, on the day of trade booking, the first entry is passed and the second entry is actually passed on the settlement date. Now basically you are passing the entry on trade date to recognize the transaction, and once it's realized you pass. So basically you are doing a two-stage accounting here. Now let's take an example. Let's say on the entry they bought a equity for cash. So on the day of T+2, on the day of T+0 where the trade is registered or booked, you pass the entry. The entry will be equity and equity book or equity account to outstanding settlements. Why we say outstanding settlement? Because settlement is not done. And on the date of your settlement, that is on T+2, you book the transaction as, you pass the entry as outstanding settlements account to bank account. So ultimately this is how the entries are passed when there is a equity, whenever there is a purchase. Now let's apply this to a practical scenario. Let's say that equity purchase, a fund buys 6,000 quantity of Tata Steel at the rate of 900 per trade, and trade date is 3rd February, settlement date is 7th February. Okay. So what will happen is on the date of 3rd February where the trade is booked. So where the trade is booked, we will actually pass the entry as equity investment books. It's for equity investments, and credit outstanding expenses because the trade is not settled. We put as in. Now here 545,000 is equal to 6,000 into 900, and on the day of settlement, that is T+2. T+2 is on 7th of February. On 7th of February 2020, you will pass the entry as outstanding settlements account to bank account. So this is the entry which is passed when there is a transaction takes place in a equity. Now let's see another example where we apply the accrual concept which we have learned. Now let's say for example, a fund have earned an income. Let's say if they have earned an income, let's say they have invested in equities and they have earned the income. Income means the company have declared, the company where they have invested, they have declared the dividend, but the dividend is not paid. So what is the entry here? Here the accounting concept is income is earned but not received. Okay, income is earned but not received. So on the day you recognize the income, the entry will be accrued dividend to dividend account. Now, why dividend account is created? Because it is an income. So, you mentioned as accrued dividend because you do not receive the cash. And on the day you receive the cash, let's say dividend is settled, the entry is passed for cash account debit because cash comes in, and you say accrued dividend, you credit it. This is the basically the two-stage accounting concept and also the accrual concept which is applied for a fund income. Now, let's say a similar example for where the fund have incurred the expenses but not paid. It means they have outstanding expenses. The day the record, let's say for example, they are supposed to pay the audit expense on the 10th of the month. Now, on the 10th of the month, they are not paid it, but they will recognize the entry. So, what is the entry? It will say accrued expenses because the expense is accrued, not paid, to accrued audit expenses, because it's a accrued expense is a debit because it is an expenditure, and you don't, since you're not paying cash over there, you're not settling, you will mention as accrued trade audit expenses. And on the date, let's say for example, the audit fees are paid on 15th of the month. On 15th, you will pass the entry as accrued audit expenses account to cash account. So, this is the entry, this is the treatment which need to be done while managing a expenses which is outstanding. Now, let's apply this scenario for an example. Now, let's say for example, audit fees which is due on 15th of April, paid on 30th of April, which is paid on 30th of April. So, on 15th of April, you recognize, the fund recognize the expenditures. It is not paid, remember, it is recognized. So, what entry you make is, you make accrued expenses debit to accrued audit expenses credit. And on 30th, when the expenditure is actually made, you make an entry as accrued audit expenses for debit and cash account you credit. This is the entry which need to be passed for any outstanding expenses which is paid later. Okay. So, we have seen like a couple of 2-3 accounting examples and how it is applied. Now, this is a typical how once this accounts are prepared and the income statement is prepared, this is how a typical statement of a hedge funds will look like. So, you have investment incomes, which is again your profits. From that, any expenses there, they will actually debit. So, from the total expenses, the debit expenses from the total income, the total expenses will be debited, and finally, it will show a net income or a loss depending on how much is the. This is a typical hedge fund balance sheet. So, it will list out all the assets and liabilities. This is the assets. It shows what are the investment securities, investment priorities note, what is the due from brokers, cash and cash equivalent, other assets, everything will be put together on the asset side. If you notice, it's about like 1,221,278,000 is a balance on the asset side. Similarly, the fund will also record all its liabilities. What is the liabilities? Liabilities can be any capital raised or any security which is sold short. All this will be mentioned along with the capital. Now, if you see, the total of the liability side is 1,221,278,000. Their assets is equivalent to liabilities, okay, plus owner's capital. So, this is an example of a typical balance sheet of a hedge fund. Thanks for your time.